Welcome back, everyone. This is our weekly update on news from the oil market. Oil prices were down approximately 1% on Wednesday, as concerns on decreased global demand could have helped the bears dominate in the latest sessions. Yet relatively tight supply that the OPEC Plus group has in store restricting output still offers some support for the commodity prices. First, we start with the US, which is now doing its work monitoring any country trying to purchase oil from Iran, and lately has found some suspicious activity in Asia. More specifically, this is regarding Hong Kong and a ship loaded with Iranian oil that was thought to be unloading in the Asian financial hub. US officials immediately took notice and promptly announced and repeated that any company or government doing business with Iran will face the consequences with sanctions. According to Reuters, the ship's initial destination was Indonesia, yet many believe its real endpoint would be China. Yet, with the US-Sino trade war still unresolved, the Chinese may be seeking this kind of attention as a retaliation action. On another front, according to Russian First Deputy Prime Minister Anton Sulanov, they have not yet decided on how to proceed with Russia's oil activities, even though he admitted that what OPEC and its allies have done so far boosted stability for oil prices. This may not be enough for the long run. From their point of view, OPEC's activities are forcing a reaction from the US shale producers that are constantly pumping more and more oil. However, from how we view the matter, Russia is in a difficult position for the time being. If they decide to go against OPEC and increase production, oil prices may be correcting lower, shrinking their revenues. In the opposite, if they follow OPEC, they could remain in the current trend, which keeps prices somewhat stable yet low. But expectations for increased demand for the OPEC oil could pick up in the later months, which creates some possible opportunities for the future. As a conclusion, from the start of May until today, Wednesday the 29th, WTI prices dropped around $5 per barrel. Evidence to that is provided through statistics that indicate hedge funds removed their bullish oil positions as strong uncertainty could be kicking in on various fronts for the oil market. Yet, the selling that took place this week is somewhat weaker than last week, which could indicate that some stability could be formed in the next days. For more in-depth investigation, please refer to our written report, which also includes technical analysis. For more information and trading ideas, make sure you visit our webpage. Follow us on Twitter, like us on Facebook, or subscribe to our YouTube channel. This is Angelos Zitis from IronFX, wishing you solid trading.